There's a question that keeps a lot of people up at night as they move closer to retirement, and it's not if they've saved enough, it's whether they've built the right portfolio, whether they have the correct ratio of stocks to bonds, whether they should tilt a little more aggressive or pull back or start over entirely. I want to talk to you about that today because I think the anxiety around portfolio construction is often disproportionate to the actual impact those decisions make. And I say that not to dismiss the question, but because I've seen firsthand how obsessing over the mechanics can pull people away from the behaviors that actually determine their financial outcome. A few weeks ago, I was reviewing a research piece from Vanguard, one that covers nearly a century of U.S. market data. And what stood out to me wasn't a dramatic finding or a bold prediction. It was how calming the data was when you looked at it honestly, how it quietly reframes what actually matters in long-term investing. So today, I want to walk you through what that data shows, why average returns only tell part of the story, and what the research actually suggests about how you should think about your own portfolio, wherever you are on the path to or through retirement. Let's start with what most people focus on first: returns. When you look at historical performance across different portfolio mixes, the pattern is pretty consistent. A portfolio made up entirely of bonds has averaged around 5% annually over time. As you add more stocks into the mix, that number climbs. A balanced blend lands somewhere in the 7 to 8% range, and a heavily stock-weighted portfolio, or an all-stock portfolio, has historically averaged just over 10% per year. That general direction makes sense. Stocks represent ownership in businesses. Over time, businesses grow, and shareholders participate in that growth. So naturally, portfolios with more stocks tend to deliver higher long-term returns. But here's where I want to slow down, because that headline return number is the thing most people latch onto, and it deserves a more careful look before we move on. When you compare a portfolio with 80% stocks and 20% bonds to one with 90% stocks and 10% bonds, the historical difference in average annual return is roughly 0.4%. That's not nothing, but it's also not the kind of gap that should be driving major anxiety or constant second-guessing. And when you compare a 60-40 portfolio, 60% stocks, 40% bonds, to that 80-20 mix, you're looking at a spread of about 1 to 1.5 percentage points annually. Meaningful, yes. Life-altering? That really depends on the full picture. And the full picture is what makes this research so worth understanding. Let me put some real numbers to this so it's not just abstract percentages. Imagine someone who commits to investing $500 a month consistently, no lump sums, just disciplined monthly contributions for 30 years. By the end of that period, they've put in $180,000 of their own money. The question is, how much does portfolio construction actually change where they end up? At an average return consistent with a 60-40 portfolio, roughly 8.8% annually, that $180,000 in contributions grows to approximately $878,000. Not bad at all for steady, methodical investing. Shift to an 80-20 portfolio, where historical returns have averaged closer to 9.7%, and that same $500 per month grows to just over $1 million. Take it one step further to a 90-10 allocation at around 10.1% average annual return, and the ending balance is approximately $1.2 million. Now, there are real differences here. Going from a 60-40 portfolio to an 80-20 portfolio adds roughly $182,000 to the final balance. Moving from 80/20 to 90/10 adds about $95,000 more. And the full gap between the most conservative and most aggressive of those three options is around $275,000 over 3 decades. Those are real dollars. I'm not dismissing them. But I also want you to notice something. The incremental gains shrink as you take on more risk, while the downside exposure, as we're about to discuss, grows significantly. That asymmetry is critical, and it's precisely what this research helps illuminate. Now let's look at the part of this data that I think deserves far more attention than it typically gets. What happens when things go wrong? Because markets don't move in straight lines. Every long-term investor, regardless of their portfolio, will live through downturns. The question is how deep those downturns are and whether you can hold steady through them. For a 60/40 portfolio, the worst single calendar year loss in the historical record has been around 27%. That's painful, but for most investors, it's navigable. For an 80/20 portfolio, that worst year figure climbs to roughly 35%. And for an all-stock portfolio, you're looking at declines exceeding 40% in the worst years. I want you to sit with those numbers for a moment, not to create fear, but to create clarity. These aren't hypothetical worst cases from a stress test. These are historical events. They've happened, and they will happen again in some form. The question is whether you've built a portfolio that matches your capacity, emotionally and financially, to stay the course when they do. Here's what the research makes very clear. The investor who earns a slightly lower average return, but stays invested through every market cycle, will, in most real-world scenarios, outperform the investor who chases a higher return, but panics and sells during a severe downturn. The damage from abandoning your plan at the wrong moment is not recoverable in any meaningful time frame. A portfolio that's been liquidated during a market low doesn't get to benefit from the recovery. This is not an abstract concern. It is the central risk for most retirement investors. There's something important about risk that spreadsheets don't fully capture, and it's this. The experience of a 40% loss is not the same at every stage of life, and it is not the same at every portfolio size. When you're 32 years old and your $15,000 retirement account drops by 40%, you've lost $6,000 on paper. That stings, but you're still earning income, you're still contributing every month, you have time. The market's recovery does the heavy lifting for you. When you're 67 years old and your $800,000 portfolio drops by 40%, you've lost $320,000. Same percentage, completely different reality. You may no longer have earned income to fall back on. You may be drawing from that portfolio to fund your daily life. The emotional and practical weight of that experience is in a different category entirely. This is why I always emphasize that risk tolerance is not just about your personality. It's about your life stage and your financial circumstances. A retiree whose monthly expenses depend on portfolio withdrawals faces a fundamentally different risk equation than someone in the accumulation phase with decades of runway ahead. And here's the piece that often gets overlooked. The trade-off between risk and return is not proportional. Each additional step toward more aggressive allocations does not deliver a proportional increase in expected return. What it does deliver is a disproportionate increase in potential drawdown depth, recovery time, and emotional strain. You're not taking on a little more risk for a little more gain. You're accepting significantly more volatility for what is often a modest incremental improvement in long-term return. For some investors at certain stages of life, that trade-off simply doesn't hold up. The math may favor the aggressive portfolio in a vacuum, but the human experience of living through severe losses may make it the wrong choice for that person at that moment. So, if average returns don't differ as dramatically as we expect, and the downside risks scale more steeply than the upside gains, what's the right question to be asking? I'd argue it's this. Which portfolio can you genuinely commit to through both calm markets and turbulent ones? Not which portfolio is theoretically optimal, not which allocation your neighbor uses, not what some financial media personality says you should own. Which allocation reflects your goals, your timeline, your financial reality, and your honest emotional capacity? Because a 90-10 portfolio that you abandon in a downturn delivers far worse outcomes than a 60-40 portfolio that you hold steadily for 25 years. The compounding advantage of staying invested is enormous, and it's an advantage that only accrues to the investor who actually stays. This is one of the clearest lessons in the data. Behavior is a more powerful determinant of outcome than allocation precision. Investors who make calm, deliberate decisions, who don't overreact to headlines, who rebalance periodically rather than reactively, who understand that volatility is the price of long-term growth, those investors tend to capture more of the market's return over time, regardless of their exact stock-to-bond ratio. Precision in portfolio construction matters less than people assume. Consistency in behavior matters far more. It helps to have a simple framework for thinking about these different portfolio types, and Vanguard's approach is practical and worth understanding. An income-oriented portfolio prioritizes stability and cash flow. It holds a larger proportion of bonds and income-generating assets. The goal is not maximum growth, it's capital preservation and predictable distributions. This approach tends to suit investors who need to access their money in the near term or whose primary concern is avoiding large swings in portfolio value. An balanced portfolio sits between the two extremes. It blends growth assets with stabilizing ones, seeking long-term appreciation while softening the ride. For many investors in or near retirement, a balanced allocation offers a reasonable middle ground, meaningful growth potential without the full volatility of an equity-heavy portfolio. A growth portfolio tilts heavily towards stocks. It's built for long time horizons and accepts wider swings in exchange for higher long-term return potential. The key caveat is that this approach works best when the money involved genuinely won't be needed for many years, and when the investor has the emotional constitution to hold through significant drawdowns without making reactive decisions. None of these is universally a right or wrong. The right answer depends entirely on your individual circumstances. Which brings us to the practical question of how to actually make this decision for yourself. Vanguard's guidance on building an appropriate portfolio comes down to a clear, sequential process, and it's one I'd encourage anyone to work through thoughtfully. Start by defining what the money is actually for, not just retirement as a general concept, but specifically. What do you need this portfolio to do? Fund monthly living expenses, provide a legacy for your children, support flexibility for unexpected costs, give you peace of mind. The clearer you are about the purpose, the easier it becomes to build an allocation that serves it. Next, assess your risk tolerance honestly, both emotionally and financially. These are two different things, and both matter. Emotionally, how did you actually feel and behave during the 2008 financial crisis or the sharp decline of early 2020? Did you stay the course, or did you make changes you later regretted? Financially, what is your capacity to absorb a significant decline without compromising your ability to meet your obligations? From there, establish your time horizon. And remember, this isn't simply when you retire, it's when you plan to draw meaningfully on this money. For a 62-year-old who expects to live into their late 80s, the relevant time horizon may be 25 years or more. With those inputs in hand, choose an asset allocation that genuinely fits. Low-cost, diversified index funds that support your chosen allocation are generally the most straightforward implementation. And then commit to periodic rebalancing. Not compulsively, but enough to keep your actual allocation from drifting significantly from your intended one over time. Rebalancing is not about optimization. It's about discipline and staying aligned with your own plan. That's the framework. It's not complicated. What makes it work is honest self-assessment and the commitment to follow through. Nearly a century of market data delivers one message with remarkable consistency. The investors who do well over the long run are not the ones who found the perfect portfolio. They're the ones who chose something sensible, understood what they were holding and why, and stayed committed through every kind of market environment. The chart we've been discussing doesn't tell you what to own. It tells you something more valuable. It tells you to be honest. Honest about how much volatility you can realistically tolerate. Honest about when you'll need this money. Honest about what helps you stay steady when markets are difficult. For many people approaching or living in retirement, asset allocation is less about maximizing returns and more about building the conditions that allow you to stay invested for the long term. And the data is clear. Staying invested matters more than getting every detail exactly right. Before you revisit your own portfolio, I'd invite you to sit with one question. If your portfolio dropped by 30% tomorrow and stayed down for 18 months, would you hold? If the honest answer is yes, your allocation may be well suited to you. If the honest answer is uncertain or no, that's important information, not a failure, but a signal worth paying attention to. I'd love to hear where you are in that reflection. Leave a comment below, whether you're still building, recently retired, or somewhere in between. And if today's conversation gave you something to think about, share it with someone in your life who's navigating these same questions. New content here every week. I'll see you in the next one.